I'm absolutely delighted to announce here today for a keynote speech the chairman of Caixa Bank, Jordi Gual. May I give you the floor, Jordi? We are all waiting in suspense to hear your keynote address. Please, the floor is yours.
Thank you very much. Thank you for your kind introduction. It's a pleasure to join again a SUERF event. I remember I was here a few years ago as an academic or as a chief economist a while ago. It's a pleasure to be back with such a qualified audience. Now, in this talk, what I would like to do is to cover essentially two topics. First, I would like to offer some reflections on the regulatory response the authorities have put together for the COVID crisis and how it has impacted the industry. And second, I would like to comment on the impending challenge of how we should be handling the presumably important increase in non-performing loans going forward. The first thing I want to tackle is the regulatory response. Now, I have to say that from the point of view of the industry, I think that we can all be quite happy about the way things have gone. The response by policymakers has been extraordinary and positive, both first on the fiscal and monetary side, of course, with the loan guarantees, with the moratoria, and then with the liquidity introduced and the credit facilities introduced or created by the ECB. This has meant that the banking industry has been able to fulfill its role, making sure that liquidity and financing reached those most in need of it. At the same time, we have had, in a coordinated fashion, a regulatory and supervisory response, which has been very positive in terms of promoting financial stability and, again, making sure that the banking system plays its role. Essentially, I would like to comment on two types of measures. The regulatory relief that has been introduced on the one hand, and on the second, the issue of restrictions on dividend distribution. Now, apart from the official measures, of course, the industry has also contributed to make sure that there were privately arranged moratoria for the debts of our clients, granting pre-approved loans and advancing the payment of pensions and unemployment benefits. All this has been extremely positive in terms of making sure that there was an adequate reaction of the industry of liquidity and financing provision to the system. And if you look at the rates of growth of lending in the current year, year on year up to October, you see that for countries such as Italy, Portugal, France, or Spain, we see rates of increase above 7%, which are well ahead of what we observed before the COVID crisis. Now, overall, I think that the regulatory response has been quite effective, but let me comment on those measures with a bit more detail. First of all, the regulatory relief measures. The ones that I would like to discuss briefly are, on the one hand, those that affect the implementation of IFRS 9, the accounting framework recently introduced, and on the other hand, those decisions that have to do with the capital ratios. In both cases, actions taken by the authorities have brought, again, under discussion, under focus, the whole issue of the pro-cyclicality of the regulatory framework. As it is well known that under IFRS 9, bank provisions should be computed in terms of an estimate of future losses, as opposed to the old system where we were taking into account losses that had already been materialized. When this framework was under discussion, we already warned that that was going to be quite a pro-cyclical framework, and it would be counterproductive in practice. Now, the risks with COVID-19 of this happening have taken place. And we've seen that the framework has been amended on the spot on two accounts. First, the way the macro models have been used has been alleviated so that the sharp recession was not incorporated into the way the provisioning system was designed to work. And secondly, there's been an additional delay in the degree to which the banks incorporate the new accounting framework. So all in all, I think that we've seen a system that works precisely the way we would like the system not to work. We would like a system that builds provision, which builds a cushion in good times that it can be used in the bad times. And that's not the way the current system works. I have to say in this regard that I still remember the system that used to be in place in Spain, which used to be called dynamic provisioning, which was examined by economists in the Bank of Spain, which worked pretty well a few years back. Now, something similar has happened in terms of the capital buffers. As you know, the capital regulation includes micro-prudential buffers, so to speak, the minimum capital requirements, and then additional layers of capital, which to a degree, the idea is that they are used in terms of fighting the cycle by the authorities. Now, the measures taken during the crisis by the ECB, their goal is to ensure that these capital buffers are used, but we've seen that in practice, they have not been used during the crisis. Now, the estimates that we have is that at least the ECB says that they release around 140 billion euros in terms of buffers that could be used by the industry, and they complain that those have not been used. And in fact, the figures that we have show that the capital ratios that we have at the middle of 2020 are similar to the ones that we had at the end of 2019. One could argue that of the amounts of the 140 billion euros potentially released by the measures of the authorities, only 1/3 have been used. And those would correspond fundamentally, those that come from the ability of the possibility of covering the P2R by different CET1 instruments by the banks, and those coming from the counter-cyclical buffer. Certainly, those coming from the P2 guidance have not been used by the industry. Now, why is this so? On the one hand, some of the buffers cannot be used by law, like the capital conservation buffer. They have to be revised by law, and if they are used, of course, they lead to the inability by the banks to remunerate equity instruments, share and AT1 instruments. On the other hand, there is uncertainty about the extent to which the buffers are going to be rebuilt in the future, and more capital will need to be accumulated in the future. And last but not least, not only do we have the equity requirements, the capital ratio requirements, we have other regulations that have to do with resolution, with the MREL, that impinge upon the buffer structure and make this buffer structure not usable in crisis times. Precisely yesterday, the governor of the Bank of Denmark had an article in the FT on this issue. On the other hand, the market also may be against, market pressure may be against the use of those buffers and the diminishing of the capital ratios. On the one hand, the ability, in a world of imperfect information, the ability to pay dividends and paying dividends sends a very powerful signal to investors and is something cherished by management. At the same time, having high levels of capital, of equity, at times where there is the potential for consolidation moves in the industry, it's also an important issue. And last but not least, having a high capital ratio, it's also important in terms of access to the capital markets and the cost of funding. So all in all, together with the fact that during this year, despite the regulatory relief, we still have some new regulations kicking in terms, for example, of the TRIM exercises. All in all, this explains the reluctance of the industry in terms of using the release of the capital buffers by the authorities. Now, I have to say that one has to be very careful in the design of these capital buffers that could be used as a counter-cyclical tool. If going forward there is an attempt to design such an instrument, one has to take into consideration that there is competition among banks going on regarding the level of capital that the banks have. And also the expectations of the supervisors, which compare across banks when they decide the pressure that they impose on individual institutions. So to get a coordinated decline in the capital ratios of the banks is not a simple issue. And quite often, I believe it would be much useful if the authorities were discretionary to release capital buffers, like, for example, the capital conservation buffer that could be used immediately by all players in the industry. Now, on the other hand, I have to say that in this crisis, the level of capital has not been a constraint that has prevented the industry from providing liquidity and financing to the industry. Now, let me conclude this part by saying that I want to be clear on something which has been quite controversial in the industry and the regulatory world for a few years. Now, it is true that a bank with a higher capital ratio, with higher capital levels, is going to be in a better position to lend to non-financial corporations. But it is also true that a process of increase of capital ratios is going to impinge negatively on the rate of concession of loans to the non-financial corporations. And in this regard, I want to warn about what's going on in terms of the capital requirements requested by the authorities from the industry. Yesterday, we heard from the EBA an announcement of the consequences of the full implementation of Basel III in terms of an increase of 15% of the capital requirements of the industry. It is true that having such a well-capitalized banking system is going to be positive for the overall economy. But it is also true that during the time of this increase, this is going to have a negative effect on the capabilities of the industry to provide lending to the non-financial world. This was already a matter of discussion 10, 15 years ago when we were thinking about Basel III. It was argued before by the unofficial quarters that this was not a relevant effect. And now, precisely, it is argued on the other way around. It is argued that if we release capital buffers, we will be providing more lending. In dynamic terms, this is effectively the case. In fact, a recent paper commissioned by the European Parliament shows that the effect is quite significant in quantitative terms. Let me move on to the other significant regulatory response, which has been the ban on the distribution of dividends, quite a contentious issue. We all know that the idea of this ban is to make sure that there is enough capital to absorb losses in the industry and to maintain the capacity to lend, and to make sure that the regulatory relief in terms of the buffers it's not transferred to shareholders. Now, the authorities said that this measure was extraordinary and temporary, and the idea was to mitigate the stigma, the potential stigma on those banks that decided that they would voluntarily not distribute dividends. Now, the authorities themselves recognize that such a ban could have negative effects. And I would like to stress that if this ban is protracted, if it is prolonged over time, the negative effects are quite significant. It stigmatizes the whole industry. It makes access to capital markets extremely costly. It discriminates among banks against the more solvent banks, against some jurisdictions. It is particularly negative at a time where the bank needs access to capital markets to comply with resolution requirements, to engage in consolidation. It affects structurally the industry, making it not investable. I believe that at this point in time, we should move on. This could be an understandable move in extraordinary times, at the time of huge uncertainty in March or April. Even investors at that time were happy to keep equity within the bank to preserve the franchise value of the bank. At these times, with the vaccines coming and with the knowledge that we have of the extent of the damage done by the COVID crisis, these times are over. And I think it's good for the industry and its capability to react to the future of to continue helping the economy, and as well for the regulators and the supervisors that they have to play a role. This ban should be lifted, and if there are restrictions on dividends, they should be decided on a case-by-case basis, on the basis of the analysis that the supervisors undertake of the risk profile and the quality of the balance sheet of each individual bank. Let me then move on to the second large item that I wanted to touch upon, and then already I will be reaching the conclusion. The second large item that I wanted to tackle is the issue of how to manage the consequences of the economic crisis for the balance sheets of the banks and the expected increase in non-performing loans. Now, I believe that so far the authorities have attempted to strike a balance between strengthening the banking sector, making sure that it is solvent, and at the same time providing the flexibility that is needed to stimulate and sustain lending. As the crisis evolves and the uncertainty decreases, there is a growing risk that the authorities will focus more on their micro-prudential role and concentrate primarily on the bank solvency and less on the macroeconomic effects of the regulatory measures. And that might discourage the extension of credit and slow down the economic recovery. And we heard something about that in the previous panel, the disconnect between what is being told to the banks at the level of GST schemes and at the high level in the hierarchy. Now, how can we strike a balance during this transition period? I think that we have to take three items into account. The first is how quickly the uncertainties in terms of health are removed, the economic activity picks up, and the extent to which the support measures of the authorities to debtors are maintained. The second is the extent to which the industry takes an adequate assessment of credit risk and manages and provisions appropriately that credit risk. And the third is whether we have good institutions, good market instruments to tackle the amount of non-performing loans that will appear, that will come up. Now, on the first issue, I think it's important that the support measures of the government, as soon as we see that the lockdowns are removed and that economic activity picks up, that there is a gradual removal of those support measures to make sure that those businesses which are viable are able to generate sufficient liquidity and restart their payments and continue to be viable. We should be making sure that there are no cliff effects that suddenly worsen the balance sheets of the banks. Now, on the second issue, maybe it's the most challenging one. On the one hand, you want the banks to be prudent, and on the other hand, they have their pre-provision profits, which should be enough to take on board a prudent approach to the potential losses. Of course, the key issue here is that we have clients which will be unable to face their financial obligations because of temporary difficulties and because maybe the government support have already been removed, but that face no structural problems. And there might be others which do indeed face structural problems. And similarly, there might be banks which have sufficient leeway to cope with additional provisioning, and others that do not have that much space in terms of pre-provision profits. And the key challenge is to have good instruments to distinguish viable firms from non-viable firms, and to make sure that the banks really recognize whatever is not in good shape in their portfolio. And of course, the classical risk here is that non-viable firms try to sort of disguise themselves as viable firms so that they receive funding. And in so doing, they keep on in business, they keep themselves in business and put in risk the balance sheets of the banks. Now, what I fear is that the current system of provisioning that we have, it's a bit rigid. In a way, you move from stage 1 to stage 2 to stage 3 with some objective indicators, and you can use subjective indicators that the only thing that they do is they fasten this process of provisioning, and they do not leave much room for forbearance when that would play into the hands of making sure that a viable business stays in business, contributes to the economic recovery, to the maintenance of employment, and to getting out of the COVID recession. It seems sometimes that the provisioning system is designed in a way such that banks are forced to dispose of such exposures. And this brings me to the third item that I wanted to touch here, the extent to which we have a good procedures to make sure that not excessive non-performing loans are accumulated in the banking system. Now, there is a review which is coming up of the European Commission Action Plan in terms of non-performing loans, which tries to encourage securitization, to improve transparency, to improve liquidation and insolvency procedures, and even the creation of the operation of asset management companies, so-called bad banks. That's fine. That's fine. But I think that when we try to improve our market for non-performing loans and the mechanism that we have to deal with those loans, we should make sure that we deal with this crisis in a different way compared to what we did last time in the crisis 10 years ago. Because the nature of the assets that may turn sour this time is quite different from the one we had 10 years ago. These are not real estate assets. These are SMEs. These are idiosyncratic assets. These are assets which are very heterogeneous and oftentimes without valuable collateral. For those assets, those come from relationship banking, and it is the banks that are the best place to handle them. It is unlikely that they will be better handled in vehicles outside the banking system, even if this I can understand, but from the point of view of the regulator is good, because those vehicles will have their own equity, which is apart from the equity of the banks. But such a move could hurt the real economy, the non-financial economy, to the extent that the move of those assets outside the banking system could be done at rock bottom prices and could hurt the viability of non-financial corporations. Well, let me then conclude. The banking industry, all in all, has been able to provide a positive response to the COVID crisis. This time around, banks have been part of the solution. not part of the problem. I think that the authorities have reacted quickly and aggressively, and that's very good and quite effectively. But also it's true that the crisis and what has happened has brought into the open some of the shortcomings of the new regulatory framework. And specifically, the accounting framework is excessively pro-cyclical, and the capital requirements framework lacks the flexibility to be used as a counter-cyclical tool in times of stress. Moreover, the use of a blunt policy instrument, such as industry-wide restriction on dividend distribution, I think it's understandable maybe in times of extreme uncertainty, but has important negative effects, both in terms of the performance of the industry, as well as for the credibility of the overall regulatory and supervisory framework. It should be an instrument left for truly exceptional circumstances, I believe, and lifted as soon as possible. And going forward, I think it is of the utmost importance that the authorities strike the right balance between ensuring that the banking industry is adequately prepared to tackle the expected increase in non-performing loans, and the need that we have that this industry continues to provide financing to households and non-financial corporations. It is understandable that prudential regulators want to ensure that the banking system is healthy, but they should also take into account the aggregate picture, the systemic picture. If they are on the side of excessive caution, they may thwart the provision of credit to the non-financial corporations, and ultimately that could undermine the role of the financial system in the contribution to economic recovery. Thanks very much for your attention.
Thank you very much, Chairman Gual, for this very rich speech. I think we will take away from your speech the importance of having a greater emphasis on the counter-cyclical properties of the regulatory framework, on not implementing bans too rigidly and too restrictively, on allowing more scope, that's what I sense in your speech, for a return to normal market discipline, to be able to make a distinction between viable and less viable firms, and also stronger and less strong banks as well. And I'm sure if we'd had time for questions and answers, I would have asked you the question, is there any friction between calling for a use of buffers on the one hand, and on the other hand, not allowing the distribution of dividends? To some extent, there seems to be some friction between these because they both seem to be pulling in different directions. So thank you very much for this keynote speech. I'm sure this is only the beginning of the debate on the post-COVID-19 recovery, which we hope to see next year. Thank you, Mr. Gual. Thank you.
Thank you.
It's an honor.